Wie können wir am besten klimafreundlich investieren? Und wie tragen Anleger dazu bei, dass die CO2-Emissionen abnehmen? Wie gelingt es, dass der Carbon Footprint, das ist Neudeutsch für CO2-Fußstapfen, wie gelingt es also, dass dieser Carbon Footprint kleiner wird? Wer zahlt, befiehlt, heißt es so schön. Wer ein Anlageinstrument kauft, bestimmt mit seiner Wahl, wo die Prioritäten liegen, und darum geht es uns heute. Meine Damen und Herren, herzlich willkommen zu unserem Webinar über nachhaltiges Investieren. Mein Name ist Philippe Béguelin, ich bin Ressortleiter Märkte bei der Finanz und Wirtschaft. Wir organisieren jeweils auch ein ganztägiges Forum über nachhaltiges Investieren. Das diesjährige hat am 7. September stattgefunden. Und jetzt gibt es dazu unser Webinar. Zur selben Zeit, am selben Ort ist auch morgen ein Webinar und dann nochmal. Wir machen also eine Dreier-Serie. And now I swiftly switch to English. Just before, we have asked you about your investments. The question is, what is the role of sustainable investments in your portfolio, and what ESG criteria, environment, social and governance, do you consider? Now we would like to have a look at the results. Okay, so as you can see now, it's quite evenly distributed. We have the most answers, the most people, 18% with number 1. We do not look at ESG criteria for our investments. Then we have also 18% for number 5. Certain ESG criteria have always been part of our investments. I call this kind of like common sense, because every now and then people say certain ESG criteria, of course, have always been important, for example, with regard to governance of a company. Right. So today we will listen to 3 speakers. The first speaker is Hortense Bioy. She's with Morningstar, the large research company. Then Michelle Dunstan, she's with AllianceBernstein, the asset management company, also known as AB. And Reuben Feldman is from Swisscanto Invest by ZKB, the Zürcher Kantonalbank. After the presentations, there will be a question and answer session. On your screen at the bottom, it says F&A, Fragen und Antworten. So please, you can ask your questions there. You can also ask your questions in German if you like, and then afterwards I will translate it. And please ask your questions already during the presentations. And if you write them in there, I will take them up in the Q&A session at the end of all 3 presentations. What you also need to know, this webinar is being recorded. Now, our first presentation is titled Investing in Times of Climate Change. What options are available to investors? The presentation is given by Hortense Bioy. She's with Morningstar, and there she's Global Director of Sustainability Research. She leads Morningstar's environmental, social, and governance research globally. The goal is to educate investors and provide them with tools to evaluate funds with regard to ESG criteria. Hortense joined Morningstar as an ETF analyst in 2010 from Bloomberg, where she was a financial journalist. She began her career as a mergers and acquisitions analyst at Société Générale in Hong Kong. I'd like to welcome Hortense.
Thank you very much, Philippe, and good afternoon, everyone. It's a pleasure to speak to you today. So in the next 10 minutes or so, I'm going to talk about the expanding array of options that are available to climate-aware investors. Investors are indeed increasingly aware of the risks and opportunities arising from climate change. They increasingly recognize that through the transition, there will be winners and losers. And they want to position their portfolios accordingly. Asset managers have responded to this new demand by launching a flurry of climate-focused funds and also tweaking existing strategies to incorporate climate change objectives, such as lower carbon footprint and greater exposure to green solutions. So a few months ago, we published a report titled Investing in Times of Climate Change. It was on the front page on the previous slide. To help, yeah, here it is, thank you. To help climate-aware investors navigate what can be a confusing mix of offerings that they seek to decarbonize their investments and help finance the transition to a low carbon economy. And in this presentation, I'm going to share some of finding. So next slide, please. Now, it should come as no surprise, given its greater commitment to a climate agenda, that Europe dominates the climate fund landscape. Europe is represented in blue here, and Europe has the largest and most diverse universe of climate funds, followed by the United States in orange, and then China in gray. So the chart at the top shows the growth of new funds focused on the climate theme, while the one at the bottom shows the growth of assets in these funds. Now, before I go further, I probably need to explain how we built this universe of climate funds. We identified them based on the names. These are funds that are intentionally marketed as climate-themed funds, using a range of terms in their names, such as climate, carbon, green, or also clean energy. Next slide, please. Now, what's clear when we looked at the objectives and the holdings of all of these funds is that there are different types of climate strategies that aim to meet different investor needs and preferences, and which result in different outcomes. So to simplify, we can say that climate strategies focus on either decarbonizing a portfolio or investing in green solutions, or both. Applying this framework, we broke down our universe of climate funds into 5 subgroups, which you can see here. So starting on the left-hand side, under decarbonizing portfolios, you have low carbon funds. These funds seek to invest in companies with reduced carbon intensity or carbon footprint. Decarbonizing a portfolio can also be achieved by just excluding the biggest carbon emitters, so oil and gas companies, for example. Under investing in green solutions, on the right-hand side, you have climate solutions funds, which only target companies that are contributing to the transition to a low carbon economy through their products and services, and that will benefit from this transition. Green bond funds is, the green bond funds are funds that invest in debt instruments that finance projects facilitating the transition to a green economy. Clean energy, clean tech funds invest in companies that contribute to or facilitate the clean energy transition. This includes renewable energy such as wind, solar, but also transmission and distribution, energy storage, and innovative technologies such as carbon capture and storage. And finally, in the middle, you can see climate conscious strategies, which represent somewhat of a hybrid grouping because they share many characteristics with both low carbon and climate solution funds. Climate conscious funds select companies that consider climate change in their business strategy and therefore are better prepared for the transition to a low carbon economy. And these funds tend to invest in a mix of companies, those that positively align with the transition and those that provide carbon solutions. Next slide, please. Now, when you look at the amount of capital invested in all of these climate-focused strategies in Europe, you can see that investors have poured money into all types, with a preference this year for climate solutions and climate-conscious funds. While last year, the investors' preference was for clean energy, clean tech funds. Next slide, please. Along with inflows, product development in climate-themed products has also increased this year, as you can see, with a total of 116 new fund launches in Europe in the first 9 months of 2021. Half of these new funds are of the climate-conscious type. You can see that in green, and include strategies that benchmark themselves against Paris-aligned indices, which were just created this year on the back of the new EU benchmark regulation. Next slide, please. Assets in climate funds in Europe have, as a result of product innovation and upward trending markets, reached new high of 186 billion euros at the end of September. Climate funds have been among the best-selling ESG funds in Europe so far this year, despite representing less than 7% of total assets in European sustainable funds. Climate funds have attracted 60% of the total net flows into the broader sustainable European fund universe this year. All types of climate-aware products have gained assets, but the one that has grown the most so far this year is climate solution funds. So in yellow, which now account for 30% of all assets in climate funds. The smallest category is green bond funds in orange, which account for less than 14% of total climate fund assets. And this is partly due to the limited, albeit growing, supply of green bonds. Next slide, please. Now, a few months ago, we put these fund groups through a series of tests using Morningstar metrics. In our study, we used 6 metrics, but here, for the purpose of this presentation, I picked only 3 metrics, which you can see here on the right-hand side. So carbon intensity, fossil fuel involvement, and carbon solutions involvement. And based on these metrics, we found that climate funds largely deliver on their promises. So for example, relative to a global market benchmark, we found that more than 90% of low carbon funds do provide access to companies with lower carbon intensity. Next slide. Low carbon and climate conscious strategies are also among those with the lowest exposure to fossil fuels. 71% of low carbon strategies and 82% of climate conscious strategies have lower fossil fuel involvement than a total market benchmark. Next slide, please. Also, as expected, the funds offering the highest exposure to carbon solutions are clean energy, clean tech, and climate solution funds. More than 90% of these have higher carbon solution involvement than the benchmark. By contrast, fewer than 40% of low carbon funds beat the global market benchmark in terms of carbon solution exposure. By excluding or reducing exposure to fossil fuel companies, low carbon funds may be missing out on exposure to carbon solutions, as these companies are increasingly developing products and services that address climate change. Next slide, please. We also looked at the relationship between carbon solution involvement and carbon risk. At the company level, carbon risk is, represents the degree to which a company's economic value is at risk in the transition to a low carbon economy. And what we found is that there is somewhat of a positive relationship between the two. That's certainly true for clean energy, clean tech funds. The majority sit on the upper hand side of the graph, which signals that diversified exposure to renewable energy is often achieved by taking some extra carbon risk. Carbon solutions funds land underneath carrying more carbon risk on average than the rest of the list, so more than climate conscious funds and low carbon funds. And this supports a common narrative that the companies trying to solve the carbon challenge are often operating in the most carbon intensive sectors like industrials, utilities, energy, and materials. These are the transitioning companies which over time, as they develop and implement their solution, should see their carbon risk decrease. Next slide. Now, so next slide, please. Now, going back to the diagram that I showed earlier, and this is my last slide, I just want to conclude that there has never been so many products available to European investors aware of the risks and opportunities created by climate change. And the number and range of strategies will continue to expand. Investors, however, need to understand that the choice of one type over another largely depends on the investor's investment goals, risk appetite, and preferences. They also should understand that these different strategies play different roles in a portfolio. While low carbon funds are well diversified and suitable as part of a portfolio co-allocation, this is not necessarily the case for climate solutions and clean energy, clean tech funds. These result in narrower and more concentrated portfolios, which make them more suitable as satellite holdings. With that, I'm going to hand it back to you, Philippe. Thank you.
Thank you very much. I have a little technical problem here. Sorry for the wait. Thank you very much, Hortense. And to the audience, please, if you have any questions to Hortense or to just the general questions, please write it down. If you go to the bottom of the screen, there is the F&A section. You can click on it and then you can write your questions down. Now I would like to introduce our next speaker. Michelle Dunstan. She is with AllianceBernstein. There she is Chief Responsibility Officer. Michelle oversees the responsible investing strategy, which is integrating environmental, social, and governance considerations throughout the firm's research, engagement, and investment process. Michelle has been with AllianceBernstein for almost 2 decades, with the majority of her time spent as an equity portfolio manager and as an analyst. She also still co-manages one of the portfolios, which is called the Global ESG Improver Strategy. The presentation is titled Incorporating Climate into the Investment Process. I'd like to welcome Michelle.
Great, thank you, Philippe, and I'm delighted to be here. And today I wanted to do 2 things. First, I wanted to discuss why asset managers need to incorporate climate change in their portfolios now. And second, to discuss how they can do that. Not just saying a commitment to net zero, but what are the biases, the challenges, and the techniques that analysts and portfolio managers can use to actually value the impact of climate. So hang on for 1 second while I share my screen. Okay, it looks like we're only getting half the screen here for some reason. There we go. Okay, so a changing climate can be described in terms of both means and extremes. Over time, those averages will change and extreme events will become more frequent and more severe. Today's society is organized around a historical understanding of those means and extremes, where we live, what we produce, how we produce it. How is it going to changing climate going to impact all of this? A couple of the major problems in analysis that we have are one, a tendency to anchor to historical norms and patterns. And two, we tend to only look for first, maybe second order impacts. We need to break these patterns and think more deeply and broadly to recognize the complex systems that are created by climate change. I'm going to illustrate that with a simple example that ties climate change to the oil markets. And it all starts with wheat. In 2010, 4 of the largest wheat exporting nations simultaneously experienced extreme weather events: drought in Russia and the Ukraine, and rain in Canada and Australia. Wheat production was down substantially, leading to low wheat inventory. Later that same year, China, the world's largest producer and consumer of wheat, experienced a severe drought that threatened its wheat harvest. China is usually self-sufficient in wheat production, but it waded into the already stretched markets and bought significant quantities of wheat. Well, what happened? The first order impact, severe weather causes disruptions in the wheat market. Second order impact, global wheat prices skyrocket. Had you predicted these weather conditions, you probably would have forecast higher wheat prices. But consider this. No one saw simultaneous but different extreme weather events in 5 of the world's largest producing nations. Based on history, these random events should be spaced out or potentially cancel each other out. A bumper crop in one area, a poor harvest in another. With climate change, these tail events are going to occur more frequently and become more severe. But it doesn't stop with wheat prices. Let's look at the largest wheat importing nations in the world. They're all in the Middle East. In these nations, food represents a very large portion of daily calories. Usually about a third of daily food intake comes from bread. The consequences of climate change, local weather conditions driving up the price of a global foodstuff, are stressors that can ignite an already volatile set of circumstances. And we've seen this throughout history. The Arab Spring would likely have come about one way or another, but the consequences or the circumstances in which it did are not inconsequential. Climate change may not have caused the Arab Spring, but it could have acted as a powerful accelerant. Instability in the Middle East has profound implications on the oil market. Actual supply constraints and the fear of deeper unrest leading to further supply cuts drives up the oil price. Sustained oil prices at over $100 a barrel and labeled the US shale revolution. That technology was emerging. It was short cycle but high cost. $100 oil enabled it to ramp quickly, lower costs, and become what is now a permanent feature of the oil markets. The Arab Spring, the oil price, and the US shale revolution took the capital markets by surprise. These third and fourth order impacts were entirely unanticipated. So why is climate so difficult to incorporate in investing? Well, climate connections are complex and multifaceted, and we as analysts can typically only see one part of the entire picture. And it's difficult to extrapolate the whole, and we have biases that prevent us from doing that. One is historical analog and risk. To define risk, we have to understand the range of possible outcomes, and often the past is a good template. With climate change, though, there really isn't a past. There are near infinite paths, and human action and reaction will have an impact. Climate outcomes also are not normally distributed. There's skew and there's kurtosis. Time horizon is another bias issue. Equity portfolio turnover is what, 50 to 100% a year? Portfolio managers are evaluated on 3 to 5 year timeframes, but compensated annually. Pension fund assets and their asset allocations are evaluated on timescales that are significantly shorter than the duration of their liabilities. These mismatches often result in us looking at something that is perceived as long-term, like climate change, but actually has short-term consequences and not incorporating it. So what happens? Physical change, that black line, is slow and gradual. It's moving continuously but steadily upwards. People in capital markets are slow to react to those early signs of change, but they reach a tipping point. Once there's enough evidence, reactions are swift. Society, people react first, but the capital markets, seeing that and anticipating further reactions, react even quicker, and pricing changes can be incredibly brutal. We actually observed this with COVID-19. In early 2020, we heard stories of a flu, but throughout January, February, and early March, it was business as usual. The capital markets, people, and largely governments failed to react. In mid-March, once there was enough signs that COVID-19 was being transmitted, things moved rapidly. People behaved differently. The government shut down economies and the stock market plummeted. We had reached that tipping point. So how can investors start to connect climate change to asset values when the path of climate change is very complex with long lead times and inherent variability? And the effects of climate change are not uniform across the globe. The correlations among these events are going to change, and the likelihood of cascading events will increase. And the human response is very difficult to anticipate. Climate's role as society runs deep. Well, we can do two things. We can start at a macro level and then bring that down to the issuer level. At the macro level, economic growth will probably be slower. GDP is labor force times productivity, and capital and climate change will slow both. Capital will be allocated towards mitigation and adaptation, which may preserve a certain level of current production, but it won't grow it, and it may crowd out more productive spending. Currently productive capital could be stranded or lost. Purposely slowing growth may be a policy response, and we saw this during COVID-19 to preserve longer-term health outcomes. Inflation and interest rates will probably be higher. Drags on productivity are inflationary, and that is going to impact both human productivity and agricultural productivity. Adaptation and mitigation capital will likely be inflationary. That additive spending could come in bursts in response to specific events, stressing the systems. And it's going to be spent to preserve the existing capital flows, not create new ones. At an issuer level, there's going to be both physical risks and opportunities and transition risks. The physical risks include damage and loss from climate change, from sea level rise, extreme weather events, water stress, droughts, storms, wildfires. These risks are easy to understand, but they're hyper-local. You need to understand your issuer's assets and trace them all up and down their value chain. Transition risks and opportunities are the impact on the business from decarbonization. And that's changing regulations, carbon prices, shifts in consumer preferences, litigation, et cetera. So one thing that we do is we teach our analysts a simple technique: follow the carbon. What are the first, second, and third order impacts on carbon on a company's income statement, cash flow, and balance sheet? So picture a factory that emits a lot of carbon. Well, is carbon being taxed in the jurisdictions in which it operates today? You should be incorporating that in your cash flows. If it's not being taxed today, could it become taxed at some point in the future? You can make a weighted average probability assessment and include that. What if there is no tax, but regulations are going to require installing scrubbers? That's CapEx out the door that's going to cost your company. What about those less obvious impacts? Consumer preferences are changing. If a competitor has developed a new lower carbon version of your product, is your company going to lose market share or have to invest to do the same thing? And what about people? Younger people in particular are making value-based decisions on where they want to work. Is your company going to be able to continue to technologically innovate or keep costs low if they're getting bottom of the barrel talent? These are all real impacts of climate change. So linking climate change to asset values is difficult, but we can't let that deter us. Perfect can't become the enemy of the good. There is no single forecast, and we need to keep learning. And collaboration is actually key here. So the last thing I really wanted to cover is what we are doing. First, we integrate climate change into all our research throughout the investment management process: our research, our decisions, and our stewardship, our engagement, and our proxy voting. We also have, as Hortense mentioned, a suite of what we call portfolios with purpose, with specific climate objectives. Some of those are low carbon, some of those are more solution oriented. And the last thing I wanted to mention is that partnership. We have a collaboration with the Columbia Climate School. We have trained all our investors on climate change. We've offered it to over 1,000 clients, and we are now pivoting to research. We have 6 different projects underway with Columbia on topics of interest to our analysts: renewables, hydrogen, how does sea level rise impact salmon fisheries? These are all things that we need to analyze and integrate into our work because they are having an impact on cash flows and valuations today. Thank you very much.
Thank you very much. My microphone was not working properly. I'm sorry. Thank you very much, Michelle, about your presentation. I would like to highlight again that to the audience, please, if you want to ask any questions, there's an icon called F&A at the bottom, and there you can type your questions. Now, I would like to introduce our third speaker, Reuben Feldman. He is with Swisscanto Invest by Zürcher Kantonalbank. There, he is in the ESG strategy and business development. Ruben manages sustainability integration efforts at Swisscanto Invest, and he leads their global commitments to the Paris climate targets. He was previously the head of quantitative research and licensing at Robeco Sam, and he was global head of index concepts at the index provider Stocks. The presentation is titled "The Climate Goal Becomes Investable." I'd like to welcome Ruben.
Thanks, Philippe. I will share my screen. So there are multiple ways to approach aligning ourselves with some sort of climate strategy that makes sense, both in terms of asset management, of course, and returns, but also having a guideline that matches some sort of international standard. What we have strained for is to align ourselves with the Paris agreements. And this has given us a political framework by which we can decide how our strategy will systematically reduce carbon, so that we actually have an impact on the goals themselves and potentially on the environment if the IPCC is correct. So, if I can, right. In 2015, the world governments got together and agreed on an agreement, the Paris Agreement, whereby they would decide that carbon emissions should be curbed to achieve a 2-degree pathway. That means temperatures will increase by only 2 degrees more than the average temperatures before the industrial era. You can see on the left-hand side, the carbon emissions recently have been huge compared to the entire of human history. And that, of course, following the industrial age, the human capacity to pollute has grown exponentially and has not really stopped. And the current pathway on which we are, if things were to continue, would increase temperatures between 4 to 6 degrees by 2050. This is linked to many potential catastrophes, some of which we are already experiencing, but of course the frequency and gravity of these events would increase. And while the Paris Agreement had a great outcome, that something emerged out of COP21, every country was left to their own devices as to determine how much they will reduce carbon emissions to achieve the climate goals. And these are called the nationally determined contributions. And if you sum all the NDCs of all the different signatories of the Paris Agreement, you arrive at this Paris National Commitment downward trend, which is basically a slight reduction from the current pollution of the economies at this point. This is a very big problem, because it obviously means while there is an agreed upon limit to pollution globally, summing all the parts clearly gives us a totally different result. And if the private sector has no impact and it's left to governments to implement the NDCs that they've committed, the Paris agreements will by no means be achieved. The Paris Agreement had two main outcomes in terms of wording. What they strive for is a temperature increase that is well below 2 degrees. For us, according to our research, it shows that we need a 4% annual reduction in greenhouse gas emissions from 2020 all the way down to 2050. And there were also some words about having an effort to limit to 1.5 degrees. This was probably intentionally vague, but if we were to follow this target, we would require a further reduction of 3.5 to reach 7.5 every year. Where are we at now? Temperatures have increased about 1.1 degrees since the pre-industrial era. And so that's 1.1 out of 2 if we're following the 2-degree target. Our current consumption is about 51 gigatons per year. And the trend, at least in the last 9 years, we don't really have very recent data that is reliable, but on the global scale up to 2018, the trend has been over 1.25% per year. And of course, 3 of those years you can see that are after the Paris Agreement. So even after the Paris Agreement, emissions have continued to increase, and they are still actually on the rise. And while we have 51 gigatons per year, the IPCC estimates that to reach the 2-degree target, we cannot emit more than 1,090 gigatons in total. For a 1.5-degree target, this number is considerably smaller. It's 465 gigatons. And to give you an idea, at the current rate, including the trend, our budget for 2 degrees will be used up by 2038 and for 1.5 degrees by 2028. And at this point, you know, how old will you be when this happens, or your children be? And this is only the beginning of the problems, because this is when the temperature increases are reached. And while we don't have a net zero economy, the temperature will keep increasing from there. So how do we turn this, this scientific logic into an investing one? We see that after, by 2050, we need to reduce carbon emissions by about 70%, according to the plan laid out by the IPCC. So this, also to make clear, a carbon neutral economy does not mean an economy where there is no more carbon being emitted. It's that all carbon that is emitted is taken out of the atmosphere through carbon removal technologies, trees or other such devices. For us, this 70% is realistic, and we have committed all our funds to be in line with this target. And so every single Swisscanto active fund is committed to have a 4% annual reduction. And this will happen through both voting and engagement, so stewardship over the companies and the portfolios that we manage, and also through asset allocation. So what we estimate is that through voting engagement, of course, not just us, while we are a major player in Switzerland, globally we're rather insignificant, as most asset managers are, but there are global efforts of which we are taking part through diverse initiatives or other processes. The markets will get better at reducing pollution relative to the production that is being created. And it should get easier to invest in markets while having a lesser carbon footprint. While that is probably true, both through voting engagement, but also client demand and probably regulation as well, there will definitely be a gap, and we're already seeing it since 2020, where the Paris agreements are supposed to be live and binding for countries, that these constraints are not being applied properly, and that the countries are not in line for a net zero economy by 2050. And definitely not aligned for a 1.5 degree trajectory, which would mean to reduce carbon emissions by 50% in 2030. And so what we're doing is applying further constraints on our portfolios, such that at least an investment in our funds will necessarily align all assets invested with Paris-aligned agreements. And the climate targets would be reached if every other investor in the world were to carry out such investment strategies. We have all our active funds are committed to 2 degrees, but we do also have some funds that are committed to the 1.5 degree target. The reason why we haven't yet committed all funds to the 1.5 degree target is because we are likely to encounter significant constraints due to that, and we do not want all our funds to be necessarily focused on climate only. Of course, we have a fiduciary duty to generate returns as well, or not as well, actually, it's the primary target. And we have estimated that climate strategy that looks at a 2 degree target can, without sacrificing returns, generate the desired outcome, both in terms of climate and in returns. We actually see that a climate strategy can add to returns by 2 separate approaches. The first is the reduction of risks. So there are significant transition risks that we are steering our portfolios away from. The disruptions due to climate change, asset depreciation, stranded assets. Of course, you have natural catastrophes and value at risk that are directly linked to physical risk of climate change events. These are only going to increase and generate more and more problems. And we look at this both on a systematic level by generating a lower carbon footprint on our investments, but also on a case-by-case investment in each portfolio. On the other hand, there is also a significant opportunity. There will be more and more demand for sustainable solutions, both because of regulation, but also because of switching consumer preferences. This creates tremendous opportunity for companies that are going to be solution providers of the futures, and also states that support such development. It's estimated that there's over $20 trillion of upside in emerging markets alone in the next 9 years. Obviously, this amount of money will be generated in those markets, but will also be generated by companies that operate internationally into those markets. And so we look forward to being able to capitalize on the opportunities that climate change is providing, while of course looking at the risk side and trying to mitigate risks, while all at the same time trying to have a responsibility towards society and to help and do our part with respect to climate change and preventing any worsening of the situation. And with that, thank you very much, and I pass it back to Philippe.
Thank you very much, Ruben. Now, my first question goes to Michelle. And I would like to ask you, Michelle, as an investor, there are different things, obviously, that you can do. On the one hand, we can divest, so we can sell stocks or bonds from companies that we don't like anymore because of climate change. Or on the other hand, for example, we can engage, we can, as a shareholder, we can vote with different companies, or we can delegate, of course, the voting. So if you compare that, this divestment and this engagement, what is your preferred approach? What is better for the climate as well?
Yeah, look, I view divestment as one toolkit in your arsenal, and one that should not be the first resort. Engagement is what is going to produce change. And that's really what we want. We want issuers to do better. We don't just want to ignore them because they're not going to go away. So, let's take a couple of sectors that are very controversial. Less than 30% of the world's oil actually goes into passenger vehicles. So even if we move to 100% electric vehicles tomorrow, and that's obviously unrealistic, you still need a lot of oil. And what powers your electric vehicle? What goes into those batteries? Buying commodities, lithium, cobalt, manganese. Rather than ignoring these companies, let's engage with them, because they are going to be here for decades to come. And fossil fuels in particular contribute to about 75% of all emissions. We actually need to get these companies to do better. And engagement works. You need to do it from the perspective, though, of why it makes them a better company. So when we think about it, it is often, we want the decision makers in the room. So that's our portfolio managers and analysts. If you have an ESG team only asking ESG questions, and then the PM or analyst, the decision maker who's going to decide whether or not to buy that stock or bond, come in and not ask any ESG questions, what's the CEO thinking? They're thinking, ESG doesn't matter. I don't need to do anything differently. Whereas if you have those tough questions asked by the decision maker and repeatedly over time, you get traction. And we always tie it back to the fundamentals. Why does this make you a better company? Well, it's going to future-proof yourself. You're going to be better prepared to face regulatory change, evolving consumer preferences, or attract and retain employees. It's going to preserve your cash flows, and it's going to make you have a more attractive valuation multiple. That's what's going to resonate with the CEO. So when we think about it, we track this. In 2020, we had 534 separate conversations on the environment and carbon with our different issuers. We actually did a report on this. We targeted about 400 of the issuers that did not have climate change targets. It's on our website. We talked about the handful that would not discuss things with us. We talked about the ones that were thinking about doing something and just needed that nudge and that confirmation that investors thought it was important. And we talked about people at different stages of their journey, just getting into doing it and why it's important. We're following up this year, and the number of engagements we've done is up about 40% over last year. And we're actually making traction. Now, if there are companies that are not responsive, are not actually implementing what they say they're implementing, where engagement is futile, then divestment becomes an option with those companies. But decarbonizing a portfolio is not the same as decarbonizing the world. You can divest away your carbon, but that doesn't actually reduce the carbon 1 ounce in the world. It really is that decarbonizing the world we want to achieve, and that's done through primarily engagement.
Right. Thank you. Hortense, you mentioned that you can, on the one hand, decarbonize the portfolios, or on the other hand, invest in green solutions. So if you could elaborate a little bit on that, because you also said that there are many, many products for investors. So the choice depends on the investment goal. How do investors find their way, which way to go?
Well, I think they need to. I mean, it's not easy, first of all. Although there are lots of options now available to investors, I think first of all, it's very important to understand, what's going on with climate change and how this is going to impact the existing portfolio, right? Because those investors already have a portfolio. So when they look at a portfolio, they need to think, okay, how should I expect this portfolio to evolve in terms of risk, and also, the impact of potentially climate change on future returns, right? And depending on the investor's risk appetite, and also the objective that the investor has, or how much he wants to contribute also to potentially to the transition to a low carbon economy, or promote the transition, then they will look at what's available and then make a decision. And also, as I said in my presentation, I think it's really important to understand that each of these climate strategy type fit differently in a portfolio. So you can switch, for example, you can switch a current diversified fund that sits in your core allocation with, for example, a low carbon portfolio, low carbon fund, but you can't really switch it with like a clean energy, clean tech fund, which will play a different role in the portfolio. So it's more a play that a product you're going to use as a satellite, because there's more risk there. It's a more concentrated portfolio, and it's not a suitable alternative to a core allocation. So yeah, I mean, it depends on how much alpha you think there is in the market. When you look at the companies today that are providing or developing new climate solutions, if you want to bet on those companies being successful in the future, then you could certainly look at those funds that really target those companies. Right. But yeah, I mean, it requires also to more and more asset managers now offering those funds, but you need the great expertise to identify those companies and the right allocation to those companies.
Thank you. Ruben, if your clients, apart from getting a decent return, if they would like to reduce the emissions in the real economy out in the world, is it enough just to divest from certain companies and to have a fund that is aligned with Paris? Is that enough to really reduce emissions out in the world?
Yeah, so that's a pretty controversial question. I think we already heard an opinion on this just recently. I would tend to draw the distinction between if you invest in a company, then you're increasing the demand for the company's stock, which means that this company can at some point have a lower cost of capital. A lower cost of capital means that this company can run more projects that have a lower profitability. And therefore, if the company is polluting by creating demand for its stock and its bonds, the investor is helping the company run more projects and pollute more. And the opposite holds, of course. If you divest from a company and you reduce your allocation overall, you reduce the demand, you reduce the price of the stock. You also you reduce the yield, you reduce the demand for the bond, and so you increase the yield. And this makes the company's operations more expensive, which means they fund fewer projects. This also has a double effect that if you take money away from a polluting company and give it to a company that does not pollute, or that even has a, let's say, a green solution, you have a double effect, because you not only increase the cost of capital of a polluter, but you reduce the cost of capital of a company that provides a solution. So I think that if you divest, you do actually have an impact on the real economy. Of course, the impact is small, but it's all about how many assets are moving. I can tell you for sure that if we were to divest from one of the major Swiss companies, that Swiss company would have a significant change in its cost of capital. In addition to that, I also hear a lot the argument about how private equity is the only way to have a real impact of such. And versus, of course, when you're selling a share of a listed stock, you're just selling it to someone else. However, if you were to buy a private equity company and that company goes public the next day, how do you then classify your impact? You're still a shareholder. And so if you draw a sort of a trend line from that, even if you're investing in $1 trillion company, every dollar matters. It matters less, but then of course, the more money you move, the more impact it has.
Thank you. The audience is asking about benchmarks on the one hand, and also about ESG labels that can be misleading. We also have ESG ratings, many different ones. So maybe Hortense, if we have this jungle of different benchmarks and different ratings and different labels, how can investors get an overview, or where can they start to get a grip?
Well, I mean, you're touching on many different things here. So it's hard to give to generalize. Yeah, there are different ratings out there, but I think they represent different opinions about companies. So I think it's important that investors really understand the methodologies behind those ratings. And
do you think there will be a kind of like a convergence towards a few ratings, maybe like in the world of bonds? It's clear if S&P gives a AAA, that's very good, and everybody knows.
That's a comparison that is often made, but ESG ratings are not the same as credit ratings. I think you should compare ESG ratings more with stock ratings and stock recommendations, for example. You wouldn't say to an equity analyst, oh, you should align, like, why you put a sell recommendation on this stock while your competitor is putting a buy recommendation? They represent different perspective, different opinions, and I think, and this is what ESG ratings represent, and credit ratings are totally different. So you're right. There are very few rating agencies, credit rating agencies out there, and because the role is very clear. It's about the credit worthiness of a company, which is totally different from measuring the ESG credential of a company, depending on whether you're looking at ESG risk, ESG impact, or a combination of both. All these ratings are measuring different things and using also different data. We know the challenges with ESG data. Currently, there's no standardization of disclosure, although it's hopefully coming, although it's more focused on materiality of risk, not necessarily impact, although not in the European Union, because this is the goal, part of the goal of the EU Action Plan on Sustainable Finance with the SFDR. We're going to have more impact metrics, but it's not necessarily something you'll see outside of the EU at the fund level, I mean. But yeah, I mean, this topic is often debated, and my advice is really to understand those methodologies and understand that they target different needs.
Thank you, Michelle. Maybe again about benchmark with regard to benchmarks to get try to get a little bit specific in the old world, so to say. We have these benchmarks like the Dow Jones Industrial Average that nobody really likes, but everybody looks at.
Yep.
Are there, or do you see any benchmarks developing with regard to ESG that maybe in a few years' time or so that everybody will look at?
I think we will, but it's an evolving process. So one, I would say today there are very few clients who ask for that because they want you to make a return against the broad market. They're not looking for you to make a return against other sustainable. They want to make money and still do good at the same time. So most clients do ask for you to outperform a broad benchmark. I think over the next few years, particularly as the EU regulations, the SFDR kicks in, we are going to see a trend migrating, particularly along climate aligned benchmarks, where we will be asked to benchmark ourselves against the two benchmarks. How did you do against, say, the MSCI ACWI, and how did you do against a Paris aligned index? So right now, I think people are looking for them to see what kind of companies are in the index, how it's performing. But by and large, it's not being used by most clients or asset owners as that denominator. When you're looking at more ESG kind of indices, whether it's laggards or leaders or ESG momentum, those go back to what Hortense was talking about. It's, whether it's MSCI or Sustainalytics or another provider, it's all based on their own methodology. So if you look at a leaders index from two of the different providers, they look very, very different. So you need to really understand what methodologies underlie them. So I do think there will be a trend. It'll likely be around climate aligned indices. But right now, most asset owners would like you to still deliver returns in line with a broad global benchmark.
Ruben, you mentioned that obviously your investors, your clients, they want a decent return. So do you try to steer them away from a traditional benchmark, or do you still measure yourself against the traditional benchmark?
We exclusively use traditional benchmarks. This is partly because of the client preference, but it's also, once you start diverting away from a traditional benchmark, you immediately make a choice. So if you were to take let's say an ESG version of a market cap weighted index from a provider, then you're using that provider's ESG scores. You're already making a huge decision that is actually active, and the ESG data is specific to that provider. It may be totally different to the ESG data of another provider, and the data often is not correct. And for us, that would be quite a constraint, because we have our own ESG scores, for example. And so if we were to then trying to integrate our ESG analysis and integrate an external score which contradicts potentially our own analysis, we would potentially be taking on tracking error where tracking error should not be accounted for. And so it can be very dangerous to use, let's say, third-party sustainability as defined by a third party. Similarly, even if you were to take a Paris-aligned benchmark, there the target should be aligned to what we're doing. However, we're doing more than just climate. We're also doing ESG integration. We have some exclusions based on our fundamental beliefs of what businesses will disappear in the future. We have also voting and engagement, which forces us to potentially divest from certain companies. And so if we cannot integrate all of these things together and are constrained on one of the parameters, this may mean that we take excessive tracking error to accomplish the optimal portfolio from our perspective.
Okay, thank you very much. So to sum up, I think it needs a lot of information for investors to get through. I think investors have to set priorities, what they would like, and of course they will, or most of them will probably still look at traditional benchmarks. So I hope in the future there will be some benchmarks for ESG that everybody looks at and that we can take. And with that, I would like to thank you for taking part in this discussion. And to the audience, I hope to see you again tomorrow at 4 o'clock for our next webinar. Thank you very much.
Thank you very
Bye-bye.
much. Bye-bye.
Thank you.